Welcome to our webinar on operational considerations for banks offered systematic risk premium strategies. I'm Jerome Abernathy of Stonebrook Capital Management, LLC, the sponsor of this webinar. In this third installment of our webinar series, we'll go into the key operational considerations when investing directly in bank offered systematic risk premium strategies. In this webinar, we'll cover all the basic information you'll need to execute and manage investments in these strategies. We'll cover a variety of topics, including how to gain access to these strategies, how trades are structured, how to manage your positions, and where the key operational risks and considerations. These strategies are mostly accessed via swaps. I'll assume you have a credit line, that is, an ISDA in place with the bank. By entering into a swap agreement, an investor pays transaction fees to the bank and receives the returns of the strategy. Remember, a strategy is simply a calculation that references securities prices. No one is actually trading anything on your behalf. So when you invest, say, $1 million notional in a strategy, you'll receive or pay cash payments corresponding to the return of the strategy on your investment. The key considerations for a swap are the tenor, that is the length of the contractual agreement, the dates for exchanging payments, and of course the transaction fees. There are a number of other important considerations as well. At the core of your investments is a swap trade confirm. This is a legal document that summarizes the terms of your investments, which strategy you're invested in, the fees, tenor, everything. The key terms listed in a confirm are the strategy name, ticker, and rules. As we discussed in the previous webinar on due diligence, the rules document codifies how the strategy operates. The notional amount that you'll be investing, the effective date of the trade and the termination date of the trade, early termination provisions. Either you or the bank can terminate a trade early under certain circumstances. The payment dates, technical issues like business day and day count conventions for fee and return calculations, the fees themselves, whether it's the running fees, change in notional fees, early termination fees, advance notice periods for changing notional and terminations, which is important for fund operators because if you need to give 2 or 3 days notice, then of course that factors in the sort of liquidity you can provide. The independent amount, that is the margin that you have to put up with the bank. Some investors will have to post margin that could typically be on the order of 10% of the notional value of the trade. Some people may not, to some counterparties don't have to put up any margin at all. And then disruption events. Disruption events are those events or days where the bank cannot transact, and those are clearly defined. So let's step through an example of a trade confirm. The beginning of each confirm lists the strategy you're invested in. An important point, as we covered in the last webinar on due diligence, the rules for the strategy are an integral part of the trade confirm. And of course, you have to know how much you're investing. In this confirm, they also list the payment terms you have to pay within 3 days and reference the payment dates where you'll either receive or make payments depending on whether you made or lost money for the period. Of course, we have to know the trade date and the date where the trade becomes effective. And here are the terms for ending the trade. It can be at the maturity of the swap or early termination by you or the bank under certain conditions that we'll get into in a minute. Here are some technical considerations. Business days are those days where the bank is open for business so you can trade in or out, and then the swap is priced on those days. Disruption days, which we'll get into in a bit, are business days where the bank can't transact because the exchange for one of the reference instruments is closed for whatever reason, such as a holiday. The day count convention is for fee and return calculation purposes. In this case, they're using the actual 360 convention. The independent amount is the margin you put up with the bank to support the trade, just like with futures. If you fully collateralize the trade, for example, if you have a fund that has the full notional amount of the trade in cash, like a mutual fund, or you happen to be a very well capitalized, well-known counterparty, the bank might not require you to put up any margin. As we covered in the due diligence webinar, a bank might charge an upfront fee or an end fee. This is their cost for putting on the initial positions with their hedge. Here are the payment terms again, as I said earlier. So in this case, settlement within 3 business days. And here's where the payment dates are listed. In this case, it's monthly. And here's where the payment amount is calculated based on the strategy returns, the notional amount invested, fees, and day count. At some point, you may want to increase or decrease the size of your position. Here are the terms for doing so. Often there is a change in notional fee that represents the cost of putting on or taking off the implicit positions. The bank actually has to trade the hedge on their side, so they do incur costs that they pass on to you in the form of this fee. Here's the fee amount. It seems they're charging for upsizing positions in this case, but not for downsizing positions. Your position in the strategy can be terminated early for a number of reasons, and these are listed in these terms. The trade can be terminated if you're down 70% from inception, or the trade can be terminated if there's a disruption event. In this confirm, if there's a material change in law, an increase in the cost of hedging, a currency disruption event where a revaluation or a large devaluation, or if the price data needed to calculate the strategy is no longer available. So those are the major items to look out for in the trade confirm. They revolve around the timing of payments, fees and how they're calculated, and early termination and disruption date provisions. Now let's move on to explore a few other items. Most investors like to know what implicit positions they have on and feed them into their risk systems. The banks can either FTP or email you the underlying implicit positions for a strategy in whatever format you need. Usually these files are sent in the overnight. You'll also need to manage your margin and cash position. That way you'll track how much money you have to send or receive on the payment dates, and whether you need to top off your margin. You can set up a simple spreadsheet that tracks your cash position based on your initial amount invested, the return on the strategy, and accrued fees. Here are some other operational details to be aware of. For example, you can't cross-margin these strategies. So if you're making money in one strategy at a bank, those gains are not going to offset losses in another strategy. And of course, you can't cross margin between banks. The frequency of disruption dates is higher for global strategies. Strategies that reference securities prices globally. So for example, in North America, Japan, and Europe, those strategies are going to then have the combined holidays for those three areas, which is a much larger number of days than the number of holidays in a single domicile. So be aware of that. NAV reporting time of day. Usually the NAVs for these strategies are posted on Bloomberg in the afternoon Eastern time, U.S. Eastern time. So if you want to provide daily liquidity or T+1 liquidity, or if you're a mutual fund, then the reporting is sufficiently timely. The settlement currency is an interesting issue. If this were a futures account and you were trading, say, futures in the Eurex or on the TIFE or in the futures that are denominated in another currency. If your base currency is dollars, then through your trading you will run foreign currency balances that at some point have to be swept back to dollars. With a futures account, you either instruct the bank to do that automatically, periodically, or you do it yourself. And you'll receive whatever execution price at that time. With these strategies, the strategy itself is based in a certain currency. So you can get a version that's based in dollars, in euros, in yen, and the exchange rate, the transformation exchange rate, is codified in the rules, and the exchange rate price that they use is codified in the rules. So you don't have to worry about sweeps as you would in futures accounts or in securities accounts. Also be aware that given the structure of these strategies, compared to a managed account, what you're doing is trading off, in the case of a managed account, uncertain execution costs, opaque, uncertain execution costs for fixed, certain execution costs. All execution costs have to be codified in the rules of the strategy. So you know, all changes in notional happen at the NAV of the strategy minus the execution costs. So you know exactly how much you're paying away in execution. If you contrast that with a managed account that actually trades securities, you don't know in advance what your execution cost is going to be, and furthermore, oftentimes that is not measured. So you're trading off uncertain and opaque for certain and transparent. And of course, in the due diligence process, you have to determine whether those fixed execution costs are fair. In general, they are, but you have to. That's part of the execution exercise. So those are the major operational considerations for investing directly in bank-offered systematic risk premium strategies. This concludes our webinar on operational considerations for bank-sponsored systematic risk premium strategies. Please join us for the next webinar where a panel of investors will discuss how they use these strategies in their portfolios. I'm Jerome Abernathy of Stonebrook Capital Management. Thank you for watching.